Yeah. Mine's working.
Hello?
So thanks everyone so much for joining us today. Before we kick off, I would just like to acknowledge the traditional custodians of the land, the Gadigal people of the Eora Nation. We pay respects to their elders past, present and emerging. So thanks all for joining. So today we're going to try and do some demystifying for you about startups and coming in. And strategies for growth. So with me today, we have Lachlan McKnight, CEO of LegalVision. So LegalVision, for those that don't know, likes to try and class itself as a startup itself. Along the journey, it has taken on equity and debt funding. So Lachlan is very experienced in advising on the challenges that he's had to navigate through that process. Nick Brown, General Counsel at AirTree Ventures, one of Australia's leading venture capital funds. Also my former boss, so I will be grilling him intensely during this presentation. My name's Sian McLachlan. I'm a practice leader in the capital raising team here at LegalVision, and ready to take on all of your capital raising questions today. So we have an agenda up on the slide, but we will be pretty free form today. Given the size of the group, we're very, very ready to take any questions you have, not just at the end, but during the presentation. So please feel free to put up your hand and ask anything you want. And with that, I might throw you to Lachlan.
Cool. So, yeah, look, what we'll probably do is, we've got the agenda here. Some of this stuff is less interesting than others, but it's all kind of important. So we thought we'd sort of structure it with, firstly going into, okay, how do you actually, put your business together to make sure you're in a position where you can actually raise capital. Talk about a few of the different options in terms of, early stage capital. So, we're talking equity, debt, other options. How you go about finding investors, and again, all the way from friends, family, angel investors, VC and beyond. And then, the step-by-step stuff I think we can probably scratch, and we'll move straight to Q&A. Before we get started, could I just get a bit of a sense in terms of the group here, who's actually running a startup or looking to start or is looking to raise capital? Just stick your hands up. Okay. Who's an advisor or sort of in the space, but not running a startup? Have any? Yep. Okay. Cool. All right. That gives us a bit of a sense as to what we should talk about. All right. Let's just get to the basics in terms of structuring before we talk about different options. You all know that ultimately there's a structure that you need to put in place to raise capital. Do you want to just run us through that so people kind of understand that before we get into the details of different types of capital?
Yeah, so in order to raise capital, and I will just clarify, when we're talking about capital for the purposes of this presentation, we are primarily talking about equity capital, so either issuing shares or instruments that are convertible into shares. But there is, of course, debt funding out there, and if anyone has any questions about that, happy to take questions after the preso. But for equity capital funding specifically, you do need to have a company. So you can't raise equity capital if you're an individual. If you're a sole trader, you will need to set up a company to do so. In terms of VC preference, I mean, it'd be good to understand from you, Nick. I know there's a bit of chatter around about, should I have one company? Should I go for a dual company structure? What's the preference?
I think in general I would say simplicity is better. There's all sorts of funky group structures that we come across that are put in place primarily for tax reasons. But frankly, a dual company structure is fine, but frankly, just a company is absolutely fine. And the simpler the existing structure we're investing in, well, A, the easier my job is, but also the easier it is for people to get their heads around, and the less sort of obstacles you come across in the investment process.
All right, so company, make sure you got a company. Don't approach any investor before you set up a company, because you're sort of wasting your time.
Although, well, you say that. We have invested on the back of an idea and then had to wait to put the check in whilst they set up the company, but they knew they had to set up a company at some point. So
you invest in pre-seed, do you?
Yeah, we do. We like to invest as early as possible, but typically it's usually a company already existing.
All right, so the structure is all organised. Let's then talk about actual raising of capital. The first thing I think is important, probably to talk about, is most businesses, and that will be, if we're honest, a lot of the businesses here shouldn't be looking to raise external capital. And I think it's important to understand that from the get-go. There's a specific type of business that, in the VC space at least, people want to invest in. Do you want to talk a bit about that, Nick?
Yeah, sure. So, how deep to go? Essentially, VC, the way that venture capital works is that 80% of your returns come from 20% of your investments. At least half of the companies we invest in are probably going to fail. Or if not fail, at least we won't get our money back. We'll get a fraction of our money back. So in order to make those maths work, the sorts of companies we are looking at investing in are the sorts of companies that are going to return 10, 15, 20 times our initial investment. And in order to reach that scale of business, you've got to sort of have certain characteristics, probably the ability to address a market that's not just Australia, typically, the ability to scale rapidly. That's why the typical venture capital investment is software, because once you've created a bit of software, you can sell it over and over and over again with very low marginal cost. And a market size that is sufficiently large that it's going to deliver the sort of returns we're looking at. A company that's focused on growth as well. So we're not focused on profit from an early stage. We're focused on growth funded by our money, and then thinking about profit once you've reached a certain scale. So those are the sort of characteristics of companies that VCs are typically looking at. We're not going to invest typically in services businesses because they're not scalable in the same way because they rely on people so much. But yeah, that's the broad characteristics, I think.
Yeah, and that doesn't mean you can't raise external capital for a business that doesn't fit those characteristics. It's just that the source of that capital will be different. It won't be a VC fund. It might be some high net worth investors. It might be potentially, if you're a bit further along, a growth equity, like a sort of PE fund that's more focused on investing in businesses that that are generating some profit. So I think this is something for everyone to consider if you're thinking about raising. Are you the type of business that, or you're trying to build the type of business that should be looking to raise venture capital money? And secondly, if you're not, should you be raising money at all? Because the best type of funding comes from customers, selling your service or product, taking no dilution, and these are the things you need to start thinking about. So before you're even going, I got to get out there and try and raise money, really make sure that you should be raising money, or it makes sense for you to do so. Nevertheless, there are different types of, assume you are a high growth business or be a high growth business and you sort of fit within what Nick has discussed. There are a bunch of types of investors that you can, yeah. That work? Okay. Okay, all right, no, that's fine. Can I hold it? Yeah. So there are different types of investors that like investing in high growth tech businesses. Sian, do you want to take us through the different types of investors that we see our clients raising capital from?
So our team helps clients along every step of their capital raising journey, so right from pre-seed through to Series D. And so along that journey, the profile of the investors can change and does change. So at pre-seed, we're often looking at family and friends types rounds. So a lot of people are leveraging their internal networks, potentially advisors, sometimes, end users of the product who are interested in what's being built. So those kinds of rounds can be easy to negotiate. Hopefully everyone's on board and on the same page. Although I have had one or two clients who maybe have an uncle who is an ex-M&A partner and has strong views on what should go into their indemnity from their niece's business. So, everyone has a different point of view, and just because it is a friend doesn't necessarily mean that negotiation process is going to be easy. So we encourage people as much as possible to be setting expectations early on. The other group of investors are angel investors, of course. In the Australian market, we have a thriving angel network, which is fantastic to see. And so angel networks are generally, high net worth individuals or family offices who are, again, interested in the idea that you are on the product that you're building. So they can be very, very useful to have. In terms of meeting those kinds of people, it really is like speaking to other founders in the space, seeing who's invested in them, or AirTree have a very, very helpful list on their website, which they compile, which have a list of angel investors in the network, and also very conveniently structure them by industry that they're interested in, and check size, I think. So that can be a helpful resource as well. And then, of course, we've got VC investors, so the likes of AirTree and other big funds in Australia. And so those VCs, again, there's variance between them, so both in terms of size and their heuristics in terms of what they're looking for in terms of the companies they want. They love B2B SaaS. But others are broader. Some have a healthcare focus. Others have, different industry specifics. Do you have anything to add in terms of that profile?
No, I think that's right. It's just making sure, I mean, there are an increasing number in Australia of pre-seed and specialist early stage venture capital funds. And so if that's kind of the stage you're at, if you're at an early stage, then they can be useful because the sorts of the size of their fund and the check size they're putting in means that the size of company they're expecting is probably less than the big VC funds. Typically, a VC is looking for a company that can return the fund, and what that means is one company that when it's sold, the returns are going to make up the entirety of one fund. And that's a lot easier when you've got a $20 million fund than it is when you've got a $700 million fund. So smaller funds can be a really useful sort of early stage investor when you're just starting out.
Yeah, and I think, on that, it's important to understand the, as Nick explained, the goal of a VC fund and how it might not align with what your goals are. So, you take on VC money, they would rather you go out of business than you generate a 2x return for them. I'm not saying Nick specifically, but in general, the VC industry. So what could be a really good result for you personally could be a bad result for your VC investor. And getting your head around that and understanding that you're signing up for a certain type of journey is very important. Most businesses are not suited to, again, repeat it because I think it's important. Most businesses shouldn't really be raising VC capital.
I think that's right. There's a classic example, a company, Envato, that was sold it was announced last week to Shutterstock, who were based up in Brisbane, had never taken any VC money, bootstrapped themselves all along the way, so used their revenue to fund themselves. And although they had, like back in the crazy days of sort of 2020, 2021, they'd had a valuation of like $1 billion. And so that valuation had come off a lot. And if they'd had VC investors, they were sold for 350 or 375 million, I think. If they'd had VC investors, that might have been a bad outcome. But because it was owned by a brother and a sister and the team that worked there, it was an amazing outcome for everyone involved because, they sold their business in a very sustainable way, they built their business in a very sustainable way, and they, walked away pretty rich people as a reward for building what was a fantastic business. Whereas if that had been a VC invested business, it might not have been the same win-win outcome for everyone.
Yeah, and probably worth talking a little bit about the legal reason for that, which is a preference share sort of structure that if you're raising external capital, and this goes all the way from some sophisticated angel investors through to obviously every VC fund, you'll only raise generally with preference shares rather than ordinary shares. Sian, do you want to explain how that all works?
So as Lachlan explained, when you first incorporate your company, you're likely to incorporate it with ordinary shares. That's generally what we see and what we recommend. Keep things simple for as long as you can. But then once investors, as he said, sophisticated investors come aboard, they may be asking for you to issue preference shares. And so if you're a preference shareholder, what that entitles you to generally is a preferential payment on liquidation of the company, generally equal to the invested amount. So that's what you hear when you hear 1 times liquidation preference. They're getting at least their issue price back. And so on an exit from the company, they can either choose to get their preferential payment, so as in the amount that they've invested back. So if they get $100, they get $100 back. Or they can choose to take share in the proceeds alongside all the ordinary shareholders in proportion to the amount of shares that they hold. That's predominantly what happens in Australia. There are variations on that, but let's just stick with what is standard.
Yeah, and so basically if you've raised using preference shares and you have a down round or you sell the company for less than the valuation in which you raised those preference shares, you're going to take a lot of dilution. The maths of it, you can read up on it. But for instance, if you had $1 billion valuation and you'd raised $350 million at that $1 billion valuation, you end up selling your company for $350 million, you're going to get nothing. Your investors are going to take the $350 million and you'll end up with nothing. So again, all things you need to be aware of when you're thinking about the type of capital you want to raise, the structure you're do it under, and so on. Finding investors. So we've talked a bit about that. Everyone complains it's hard to raise capital. It's a lot easier to raise capital now than it was 10 years ago, I can tell you that. And one of the things you've always got to be, I think, conscious that maybe the reason you can't raise capital is because your business isn't a very good business. It's easy to blame the externalities, but I think it's very important to reflect on, is my business an investable business? But both from a VC side of things, but even, a sort of more modest, I just need a bit of capital to build a smaller business. But in terms of how you go about the process of raising, I mean, I think it's fair to say you see a lot of businesses start off with their network, which we've kind of gone through, and the bigger your network, the more likely it is you'll find someone who'll like what you're doing and be willing to invest. And that's really a job in and of itself. When you're getting on, we decided I want to raise capital. It's a full-time job to get out there networking. And there's obviously angel investor groups. There's coming to this type of event and talking to people post the event. There's events like the Sunrise event that the Blackbird put on last week, and so on. Obviously, all the VCs have a process. Nick, do you want to go through your process if people will approach AirTree?
Yeah, sure. I mean, our investment split is typically about 50% inbound, i.e. people approaching us, and about 50% outbound and through the kind of network of the community that we work on developing and that we have contacts through. Typically, as with everything, a warm intro, i.e. someone we know introducing us to you, is kind of the best way in. We do take unsolicited pitch decks. We have an email address on our website that you can send your pitch deck into. It's not necessarily the best way into an organization like AirTree, largely because a pitch deck without context is quite difficult to analyze. It's quite difficult to figure out, are these people are these people legit? Is their business idea a good one without being able to contextualize it? So in that sense, it's a little bit more hit and hope than a warm intro is. But I mean, our investment team have meetings with over 1,000 founders every year. So we meet a lot of people. We typically make 15 to 20 new investments every year. So the funnel, narrows pretty rapidly as you move through it. We always try and give, if it's a no, we always try and give a quick no, because there's nothing worse than stringing people along and then telling them no. It's the worst of all possible worlds. Yeah, there are a few ways, but I think, as Lachlan said, getting yourself involved in the startup ecosystem, there's so much that you can do now in Sydney, and that's changed a lot over the last 10 years. But there are so many events. All of the VCs have mailing lists, so you find that information. They all put on events that you can just pitch up to. And even if you talk to two people and get some free beer, right? It's a good opportunity to start talking to people in the business and start developing your thinking around how you want your business to grow.
We didn't mention accelerators as well, actually. Everyone who's at the back, if you want to sit down, there's some spaces up the front here. So if anyone wants to come down and have a seat, feel free to. If you're happy hanging out back there, that's fine. Okay. Do people have questions? If you're going to have a question, can you put up a hand, just so I know how many questions we're going to have? We're going to have a few. Okay, all right. Yeah, not that many. But look, do you want to go through the next bits and then we'll go straight to Q&A?
Step by step. Is that what we're talking about? No. Oh, you want to go and then come back to Q&A. Okay, I see that. Okay. Before we get to Q&A, just letting you know, we have another event coming up. So on Global Expansion Blueprint, Insight from the Experts. So that's on Wednesday back here at LegalVision on the 26th of June at 6 p.m. So if you are thinking about expanding overseas, we'll be covering all the key issues you need to consider in in undertaking that. Also, LegalVision, the way that we engage with most of our clients is through a membership basis. So our members get these amazing array of benefits that you see on the screen here, and the membership has really been designed with the startup and the early stage company in mind. You know, lots of these companies have a lot of legal needs, but you know, obviously need cost certainty and over their legal spend, and so that's what we achieve through the membership. So for everyone here, you can claim a complimentary legal health check. So if you follow the link, to claim, please speak to a LegalVision member or respond to our post-event email. So you'll be getting an email after this, and there'll be a link on that. And if you click that link, you can you'll arrange to have a call with our team, and we'll run through how the membership can benefit you. Oh yeah, I do. Yeah, perfect. Maybe we can talk to you later about how much you're enjoying the LegalVision membership. If you want to contact Nick, here are his details on the slide. He is very open to receiving your unsolicited pitch decks, so please send them through.
I have been banned from looking at pitch decks. Luckily, there are people in our team that are vastly more qualified than me in terms of looking at pitch decks. So, but I am happy to receive them, and I will always pass them on to the appropriate people.
Now for Q&A.
So yeah, Q&A is always the best bit. So we've basically got 25 minutes, and yeah, hopefully let's start off. You had a question. Nick, do you want to pass your... yeah. No, because we're filming, so yeah.
Thank you. All right, well, I've got a bunch of questions, but I'm going to keep it short, but I'm also going to start with a warning. So, Lachlan, I'm going to need a warm intro to Nick, and I'm going to need a warm intro to AirTree from you. and I'm going to look you up for a free consult, okay? So, just saying. So, what kind of deal flows in terms are prevalent now in the Australian market, and how is that influenced by the economics that's happening globally?
Do you want me to go? All right. I mean, I think it is very influenced by the economic sort of situation globally. Like, in terms of startup funding, 2020 and then 2021 were exceptional everywhere in the world in terms of startup funding, and certainly I can speak sort of about VC funding in particular. We did more deals, invested more money in 2021, like we did, I think, twice as much in 2021 as we did in 2020. Like, it was just, I needed a rest at the end of 2021. And then things slowed down quite dramatically through round about sort of Easter 2022, and have been slower for the past kind of 18 months. But I think we've noticed a real uptick this year in terms of startup funding, and I think that's backed up. There's an organization called, or a newsletter called Cut Through Venture, and they do a quarterly update on kind of venture funding and startup funding generally. And the figures bear out that 2024 has been, I think, significantly busier than 2023 was. And so I think there's a lot of investors with money available to invest, is my impression.
Yeah, that's true. Certainly 2023, our revenue from startup capital raising was a lot lower than previous years. So we see that from just a number of deals perspective. The other thing, of course, is so much of it's driven by two things in the VC space. VCs are wonderful, but ultimately a lot of them just kind of follow the kind of vibe, right? So if people are scared of investing, then everyone's scared of investing, and deals don't get done. And then secondly, obviously, the interest rate environment's super important. So all of the sort of valuation side of things on capital raises, and it's private equity and VC, is obviously done, with a certain cost of capital calculated into the valuation numbers, and cost of capital's gone up because interest rates are going up, which makes a lot of maybe more marginal deals that would have got done in 2021 not happen now because the numbers just don't make sense. So I think those those two, and then lastly, I think Australia is still a big follower in terms of what's going on in the US, deals getting done there, deals getting done here, and on top of that, in the sort of 19 to 21 period, there are a lot of US VC funds who were investing in Australia. Most of them have now retreated, not investing in Australia, and that's obviously then meant less deals, but also, frankly, lower valuation. So all those things combined.
Yeah, that's exactly right. 2021, everyone in the VC industry would admit they overpaid for investments because the choices were overpay or don't make any investments. They were the only two choices. So I think things have become a bit more disciplined since then, just because they had to, and it couldn't really continue. Any bubble's got to burst at some point. And so valuations have come down, but the VC funds have got money to invest, because if we don't invest it, our investors are unhappy with us, because otherwise they may as well just shove it in the bank. If they're going to give it to us and we're just going to sit on it, right, there's no point. So we have to invest. It's just everyone's being a bit more disciplined.
So a lot of investors claim that the best investment comes with more than just cash. So there's a strategic element and perhaps introductions and things like that, ranging from advisors to VC funds to corporate venture capital. How do you see these promises documented into legally binding obligations on the company's behalf?
Pretty easy answer. They're not documented and legally binding anywhere, is the answer, and my job is to make sure they're not. But at the end of the day, a good investor, there are wildly differing views on how much value add an investor is real or not. I'm sure Lachlan has some views on the issue. But at the end of the day, we have a pretty big team of people, our portfolio success team, dedicated to just helping our portfolio companies. And the reason we do that is a lot of it's just self-interest, right? Because if our companies succeed and we can help them succeed, then we do well out of it. And not only that, but the VC market, particularly in Australia, is still relatively competitive. And so if we can sell companies on the services we're going to help them with, then that's a competitive advantage for us in terms of winning deals. And the absolute number one thing that all our portfolio companies need help with is recruitment. The number one thing that every startup founder will tell you is the most difficult thing about having a startup is finding the right people and keeping the right people. And so we've got a dedicated function whose job is just to help startup founders with their recruitment requirements. So that's a kind of, we think that's a value add, and the feedback we get from our founders in our portfolio is that that's a value add. But yeah, there are certainly, I've heard some strong views expressed elsewhere that value add from investors over and above their money is not necessarily widespread.
I think the approach you should take when you're raising capital is to be happy with the capital you're raising and the price you pay for the capital, so the dilution. If you're happy with both those things, you should see any additional value that's going to be created, any additional help that the VC is going to give you as just a bonus, right? Don't see it as part of the deal, and if you operate in that way, you're never going to be disappointed. It doesn't mean you shouldn't look for to work with the investor who you think is going to add the most value, but ultimately you have to be happy with the price you paid for the capital, and if you're happy with that, then you're not going to be unhappy down the track if you don't get enough help, in inverted commas. Just got up the back.
Thanks. Oh, can you hear me? Yeah, good. Yeah, first of all, thanks for putting on the evening. It's been great so far. I hope my question doesn't ruin it, but I'm that way. I'd like to ask Nick first, followed by Lachlan afterwards, right? I want to get the VC perspective on the power of a lead investor, both pro and con, and then Lachlan, for you to give all of us here the advice pro and con as well.
When you say, hold on, when you say power of a lead investor, do you mean what can go right and wrong depending on who your lead investor is?
I guess what I'm thinking about, if you follow along with a lead investor, as AirTree, for example, are there pros and cons? Do you prefer to be a lead investor?
Yeah, okay.
And then the quagmire that might be on the other side.
Yeah, I get that. And we do both, and particularly in 2021, as Lachlan mentioned, when US funds were coming over, we would often partner with a big US fund and invest alongside them. The pros are you get access to companies that you wouldn't ordinarily have the firepower to have access to. Like, examples like big US funds, Tiger Global being the big one, were just throwing money around, throwing $80 million at a seed stage company at a valuation that we realistically, we just don't, Australian funds just don't have that sort of money to write checks that big. We would have too few companies in our portfolio if we did that. So it's access to companies that ordinarily you would not be able to get access to. But we prefer to lead. And the reason for that is because the biggest determinant of success in our portfolio is our ownership stake. So we need to have a sufficiently large ownership stake just to make the economics that I talked about earlier stack up. Like, we want an investment that's going to return the fund, and if we've got 10% of a company and we've got a $100 million fund, then that needs to be, $1 billion outcome. If we've only got 5% of a company, then it just doesn't, the economics don't work.
If you've led Series A, will you also lead Series B or not?
Typically not. I mean, generally, if we've led, it would be unusual. It has happened, but it would be unusual for the lead the next round. It does happen sometimes, but often by the time a company's got to Series B, it's sort of beyond our scope to lead it, depending on how much it's grown and what the valuation is. So we do like to lead. The con of not being a lead investor is that your ability to influence the company, to help the company, to be involved in decision making if they want you to be, is much less. Typically, if you're not leading, you probably won't have a board seat, and there are differing views within my organization about the value of having a board seat. We have some partners who do not believe that that's a value add to us. We have other partners who absolutely insist on it. So it's not an absolute requirement, but generally, if you want to be involved and you want to help the company, then having a board seat is a really useful way to be able to do that. So I think those are the main pros and cons from my perspective.
Yeah, and look, you're always going to have a lead investor. The question isn't you're going to have a lead investor. The question is, are there going to be more investors than the lead investor, really? Because someone, you negotiate the deal with someone. And so I would think most of the deals you do, VC deals, there's more than one investor, right? I mean, do you want to?
As Lachlan said, there's always a lead, just depends who that person is. And in the Australian market, like, all investors are pretty accustomed to the fact that the lead will negotiate the terms and everyone else will just fall in line. It's very rare that people will divert from that or have additional requirements that they need in your docs.
And you'll find that investors in the Australian investment community have a large incentive to play nice with each other, because the Australian investment community is realistically a small but growing one, and it's not like Silicon Valley where it's sort of, you know, between investors, when deals are competitive, it's knives at dawn. Here, we all, at least on the surface, play nice with each other.
Hi. I just have a question regarding founder shares and what investors think of that. And assuming it's not a seed round or any early stage investments, assuming that the company can bootstrap to profitability and is just looking to scale with larger Series A, B, C rounds, founder shares and non-voting shares from investor, what's VC's thoughts on that?
Yeah, maybe I'll start, and then Nick can tag on.
Yeah.
So, in my experience, if you have a different class of shares, say founder shares, which are given some different form of rights, the VC's strong preference is for everything just to convert into ords, just to keep things as simple as possible. I have seen isolated cases where maybe founders do have a different class of shares, which maybe would entitle them to dividends and not need to pay on the others. But in those cases, the VCs are then just going to put provisions in your agreement requiring you to pay everyone at the same time in any case. So you don't get the benefit of that alternate share in the end.
Yeah, I think that's right. There's obviously some they're more common in the US, I would say. Like, you know, Facebook Meta is the classic example, whereby Zuckerberg can kind of control most of the votes. They're not super common in Australia. They generally, I think, as a VC investor, well, two things. Number one, there's sort of the benefit of simplicity. And then number two, we wouldn't sort of reject them out of hand, but we'd want some explanation for why they were appropriate. I think in general, our view is, when it comes to voting, is a relatively egalitarian one. We would like everyone to have the same voting rights, unless there was a compelling reason for that not to be the case. And sometimes what is more common is if there's a group of founders that effectively their voting rights are pooled, and like one or two of the key founders get to control the voting rights of that pool of shares. That is a bit more common, and we do see that a bit, but generally investors having non-voting shares would raise some alarm bells.
But again, like, totally depends on, ultimately, the market for the shares that you're selling. Because what you're doing is selling shares in your business. If you're the hottest startup since Canva, every VC in Australia wants in, you've got, 5 term sheets from the big US VCs, then, you can sort of dictate the terms under which you're going to raise capital. So so much of it comes down to supply and demand. That's the way you've got to think about it.
A lot of weight is placed on the valuation of a company. How does a VC value a startup company?
That is a good question, to which there is not one answer. Valuation, particularly at a VC, at a startup level, is more an art than a science. And I probably shouldn't entirely say this, but often it is reverse engineered. So we go, all right, how much do we want to invest, and what size stake do we want? Right, that's the valuation. Because at the end of the day, if we're investing at pre-seed stage, we're investing in some people and an idea. And so there's nothing to hang a valuation of. There's no revenue multiple. There's certainly no EBITDA, and there's probably not going to be any for a long time in the future. So it's a case of, all right, figuring out, what level of ownership we require. When a companies are slightly more advanced, then there are metrics we can use, things like multiples of revenue, multiples of ARR, looking at their customer acquisition costs, looking at their user metrics if it's a kind of online thing. So there are metrics you can use as a company gets more advanced, but certainly at an early stage, it's sort of often just a bit finger in the air.
Sorry, thank you for today. I recently sold a business to a US private equity fund, and I feel like I can sit up there as a wounded zebra and answer a lot of those questions. But the questions I have is, number one, I've learned a lot of expensive questions. I will say, number one, I'm really enjoying LegalVision. Seems like I'm one of the few people here who is a member.
Thank you.
It's fantastic. I had 3 meetings with you today, 3 the day before and 3 tomorrow. So I'm very happy. And they're all free, by the way, on the membership, which I've spent other money with you. But anyway, it's fantastic. So big plug for you there. But 2 things. One, I went through a lot of expensive lessons with private equity US during 21. And I was sent a clip that was it was called a 2 and 20, and it was the fund behind my fund investing on the daisy chain 2 and 20, and I thought you could explain that both to me and the others about that, because it was quite cynical about the way, and you mentioned something earlier about them being better to ditch your company in their portfolio than not, and it's not a good outcome for you, but good for them, and I didn't quite understand that. But the daisy chain sort of thing of the money would be good to explain. And number 2, I had a meeting today on structuring with one of your guys, and would you recommend to structure a startup to be ripe for a Horizon event in the future? Is there any tips and tricks with that?
Yeah, sure. So on the, I guess, how you can end up with nothing after raising a whole bunch of venture capital money and selling the business for a reasonable amount. Again, that goes back to the preference share structure. And if you're talking US private equity, often if you're taking money from US private equity, there'll be more than one-time liquidation preference in the capital structure. So what does that mean? It means the investor is investing and saying, maybe I need to get, if you sell this business, I need to get 2 times my money, or sometimes 3 times my money back, right? And so what they're effectively doing is turning the equity into a hybrid kind of debt and equity structure. So I mean, it's something to look out for. You don't see it too much in early stage or VC in Australia, although it's starting to emerge. Yeah, there have been a few things that we've seen where investors are trying to, I don't know how you describe it, but
take advantage of a company's distress.
Yeah, it could be distress, or potentially, ultimately, it comes down to the question of what is the demand for your securities. It's supply and demand. If you've only got one investor who's interested, then they're going to dictate terms. If you've got 10 investors interested, you can dictate terms. So that's on the sort of the liquidation preferencing. On the 2 and 20, I assume we're talking about just the...
That's 2 and 20 is the standard fund compensation model. So typically, most venture private equity, well, certainly most venture funds in Australia, I can't really speak to private equity funds, the general partner is compensated, so the venture firm is compensated in 2 ways. We take a management fee, and that's 2% of the capital commitments of the fund. And that's typically used for, all the expenses of running a venture capital firm, employees, rent, all the kind of usual business expenses. And then we take carried interest, which is equal to effectively 20% of the profit element of the fund. So typically the waterfall works. Investors get all of their money back. Then from then on, any additional amounts received into the fund are split 80% to the investors, 20% to the venture capital firm.
Does that answer the question on the 2 and 20? Okay.
Yeah, what I would say is, in the US, I think it can be. In Australia, I think because we have a smaller ecosystem, I think if investors screw over founders, screw over companies they're invested in, word gets out and people don't want to take their money so much anymore. So I think that acts as a bit of a disincentive to being overly cynical or overly purely money driven. I think there is an element of if we can create an exit that returns something to the founder that's not just a zero for everyone, then even though the effort to do that is sort of disproportionate to the reward we would get, we still probably have an incentive to do that, but just because from a reputational point of view.
Yeah, I think it's more, it's not so much, I think on the raising capital part, you raise VC capital, and your business doesn't really grow quickly enough. The issue you've got is you've got an investor on your cap table whose interests then aren't really aligned with where the business is at, right? And it means a couple of things. Number one, they're not likely to invest again on the next round. And that can be a problem for you if you've raised, let's take AirTree as an example, you've raised some capital from AirTree and AirTree then don't want to invest on your next round. That's a bad signal to the market. That's AirTree going, this company is a bit shit and I'm not going to invest in it in a nice way. And so that's a risk for you in terms of being able to raise more capital. The other thing is, if you look at any VC fund, there's usually 3, 4, 5 partners, right? So they're the people who are often on the board or really invested in helping the company grow, so on and so forth. There's only so much time those partners can spend on helping their portfolio companies, and they want to be investing their time, effort, energy in those portfolio companies that are doing the best and that have the best prospects to succeed. And so I think the risk, if your business isn't kind of growing at the rate that it needs to be, is that you that potentially the VC fund aren't that interested. It's not that they're actively trying to screw you, it's that they're not going to really put too much effort into helping you. Yeah. So, and then on the structuring point,
Yeah, I mean, I think we touched on this at the start, but yeah, you just need, I would say as a starting point, you need a company, whether or not you want to go down the dual company structure route. And just to explain that a little bit further, some people choose to set up a dual company structure, I've talked about on your consult today, as a way of kind of protecting the valuable assets in your business. So the idea is that all the valuable IP and the cash sits at the holding company level. Your operating company level is the one trading, contracting with your suppliers and customers. So if anyone sues you, they can only have recourse to the operating company. And so for that reason, some people like having that from the get-go. The reason why you might do it earlier rather than later is the longer you wait, it does become a little bit more expensive. Like the more shares you have an issue, especially if you've got multiple classes of shares or convertible notes, it's more expensive to put in that holding company later if you want to do it. Not to say it's not possible. If you did, our practice leader, Helen, at the back can provide you with some advice on how to do so. But as Nick said, it's definitely, if you have one company, it doesn't rule out raising VC funds in the future.
I think we're almost at the end. Should we take one more question?
Sure.
Yeah, sorry. Last question.
What is your opinion of safes?
I love them, but
yeah.
I'll leave it.
As an investor, they're great. They're super easy to agree. They're very simple, as in as the name suggests. If I was starting a company now, I would raise my money on a safe. The only hesitation I would have is that don't go down the route of having multiple layers of safes, because it overcomplicates your cap table and makes it difficult for the next investor coming on board.
And you can find out that you actually own a lot less of the company than you think you do. Too.
Yeah, I mean, I'm dealing with a client at the moment who has gone through exactly that. They've issued 64 safes, and so we are now realizing how much dilution that has cost them, which they didn't appreciate at the time. And so that is the thing I encourage you, if you are issuing lots of safes, make sure you're modelling out to actually see what the ultimate impact will be. The other thing to be wary of is like lots of investors these days will demand a valuation cap in your safe. And so it's really important to model out what that will mean, because that's ensuring a minimal level of dilution, a minimal holding for them. And so just appreciating, what the impact will be.
64 states before they became legal members.
Yes, very true. They have said to me almost every call, we wish we spoke to you before this happened. So they're now making full use of their membership.
Cool. We have to wrap up now, but thank you everyone for coming along. And we'll do some networking now. And obviously, any questions you've got our details, and please attend the next event. Thanks. And thanks, Nick. Thank you.